Welcome to 39 Essex Financial and Regulatory Update as part of our series of banking and financial webinars and podcasts. I'm Fenella Morris KC, and I'm joined by 4 members of our banking and finance team to talk about an array of topics and with some contemporary issues. What I'm planning to do is invite our speakers to speak one after the other and take 1 or 2 questions after each talk, and then see if we have more time for questions at the end. So if you do have questions, please type them into the chat, and then we can raise them with the speakers anonymously and without identifying you. So the first of our speakers is Ella Grodzinski. She is developing a regulatory practice in Chambers, and she has a particular interest within that in financial regulation. She's spent some time on secondment at FOS, and she's going to speak to you about Motor Finance Commission issues. Over to you, Ella. Thank you.
Good afternoon, everyone. I'm going to be speaking about Motor Finance Commission. I'm aware that there's a range of expertise in the virtual room today, not least that some members of the legal team from the Financial Ombudsman Service are themselves here. So welcome to everybody, and I apologise in advance if some of what I say seems blindingly obvious. Hopefully some of it will be news. I'm going to share my screen. Let's hope this works. Bear with me. Okay, I think we're in business. So there's a big update in the world of Motor Finance Commission, which is that the case of Johnson and First Brand Bank Limited has been decided by the Court of Appeal. This is a case which has been trundling along in the context of Motor Finance Commission, the Motor Finance Commission world for a while. This case was 3 conjoined cases, and the Court of Appeal handed down a judgment on the 25th of October just now, which has caused some fairly momentous shockwaves in the world of Motor Finance Commission. Taking a step back for context, there's been an ongoing scandal brewing for a number of years about the history of Motor Finance Commission and some unfair dealing that is said to have been going on in the world of motor finance. The typical structure of motor finance deals and the motor finance market that has existed up until a few years ago was as follows. In a scenario where a customer wanted to purchase a car but did not have the cash to do so, they could approach a motor car dealer, explain that they wanted to purchase a car, and the dealer would offer finance to that customer. The finance would be provided by a lender, and the motor car dealer would typically present this finance option as the best available or the best for your needs from a panel of available lenders. The motor car dealer would therefore be acting as a credit broker to the customer who was seeking to purchase a car. If the customer or the consumer accepted the offer of finance offered to them by the dealer would sell the car in question to the lender. The lender would in turn enter into a hire purchase or a conditional sale agreement, which is collectively referred to as a credit agreement, with that consumer. In other words, here we have a consumer approaching a motor car dealer who acts as a credit broker and introduces a lender back to the consumer. There's a diagram on screen for those of you who are visual learners like me. Crucially, the consumer was aware of part of what was going on in this relationship, but did not know fully the arrangement that was going on behind the scenes. The consumer would know the price they were paying for the car, the amount of any down payment, the rate of interest they would have to pay, how much they would have to pay the lender in installments. But crucially, the consumer typically was not made aware of the deals of the arrangement that existed between the lender and the dealer, nor, crucially, how this arrangement may have affected the price and interest offered under the credit agreement to the consumer. Prior to 2021, a common method of structuring this arrangement was called the discretionary commission arrangement. This allowed, under this agreement, the lender would allow the dealer, in other words, the car dealer acting as the credit broker, to itself decide or negotiate the total charge of credit, including the interest rate offered to the consumer. The lender would then pay the dealer a commission that was calculated based on the interest rate that the dealer offered the consumer. In other words, there was an incentive for the dealer to offer a higher interest rate to the consumer to maximize the dealer's own commission that they received. The FCA banned this kind of a structure, which was known as a discretionary commission arrangement, with effect from January 2021. That removed the incentive for brokers to increase the interest rate that a consumer paid for their motor finance. But there is still a whole suite of cases going on as a result of this historical arrangement. The other aspect of this that was crucial was that there were degrees of transparency that may be available to the consumer as disclosing what kind of an arrangement there was. In a lot of cases, there would be a standard clause in the terms and conditions that the consumer saw saying that the dealer may receive a commission, or a commission may be payable by the lender, or that in the lender's terms and conditions that they may be paying the dealer a commission. Back to the case of Johnson and First Round Bank. In each of these three conjoined cases, a discretionary commission arrangement was in place between a broker and a lender. In the first of the conjoined cases, Johnson, and also in Wrench, the commission arrangement was half secret, where the lender's standard terms and conditions made reference to possible payment of commission. In the case of Hopcroft, the commission was fully secret. In each of these three cases, the claimant sought rescission of the credit agreement and repayment of the sums representing the commission. The claimants all lost at first instance and appealed to the Court of Appeal. The issues in the Court of Appeal case were, number one, whether the dealers owed the appellants a duty to give them disinterested advice as credit brokers. Two, whether the dealers owed the appellants a fiduciary duty. Three, whether the commission in Wrench's case was secret. Four, whether Johnson had given informed consent to the commission payment. Five, whether Johnson's lender was liable as an accessory to the dealer's breach of duty. And six, whether Johnson's relationship with the lender was unfair within the meaning of section 140 A to C of the Consumer Credit Act. Several key findings were made in this case. Firstly, disinterested advice and the duty to give disinterested advice. The court unanimously held that the dealers in each of these three cases had clearly been acting as credit brokers, as we've just discussed, and that the dealers had been at least purporting to obtain for the consumers suitable and competitive finance offers from a panel of lenders, and that the consumers in each case had trusted them to do so because the consumers could not obtain such finance themselves. There was therefore a duty on the dealer to either A, give disinterested financial advice, or B, make it clear to the consumer that the dealer themselves had a financial incentive to present an offer from a particular lender. There had therefore been a duty, given that the dealers had not been making it clear that there was a financial incentive, there was a duty on the dealers to give disinterested financial advice, and they had failed to do so. In terms of fiduciary duty, following the key case of Wood and Commercial First Business Limited, the dealers owed a fiduciary duty if they were acting on behalf of the consumer in a capacity which involved an obligation of loyalty and where the consumer placed trust in the dealer. Given the nature of the tasks that the dealers were performing when acting as credit brokers and organising the relationship between given the relationship between the parties, the dealers were held to owe an ad hoc fiduciary duty, which arose due to the nature of the relationship between the parties. And they had breached that fiduciary duty in this case. In terms of disclosure of the commission, in Wrench, the commission was held to be fully secret. There was a reference in the standard terms and conditions to the possibility of a dealer receiving commission, but this reference in the terms and conditions was so obviously deliberately buried in the small print that there was no way that a standard consumer, particularly an uninformed standard person off the street, would be able to spot that reference. And the key was whether enough had been done to bring to the buyer's attention the fact that there was a possibility that the dealer would be receiving commission. In other words, had enough been done to bring the salient facts to the buyer's attention. And the court held that no, there had not been enough done here. The consumer had not been effectively put on notice that the dealer might be receiving commission. By contrast, in Johnson's case, Johnson was told about the existence of the commission, but he was still not told all of the material facts that might have affected his decision as to whether or not to enter into a credit agreement. In particular, he hadn't been told that the dealer had an undisclosed obligation to give one particular lender first refusal. He hadn't been told that the dealer would receive a commission from that lender. He hadn't been told that the price he was paying for the car was inflated to cover that commission. He hadn't been told, therefore, that the dealer might not be giving him unbiased advice. And in fact, he'd been positively misled into believing that the advice he was being given was impartial. And it was therefore clear that the consent he gave was not informed consent to the commission arrangement. There was also an important finding on accessory liability following the key case of Herstanger, not sure how you pronounce it, Limited, and Wilson, that the lender was liable as an accessory to the dealer's breach of duty. The lender must have known that the dealer was acting as a credit broker and must have been turning a blind eye to the dealer's breach of duty. And that in and of itself was sufficient as a finding of dishonesty, such that the lender was guilty of accessory liability in this case. Consequences. This case sent shockwaves across various financial markets, but some tangible consequences. The FCA was already investigating discretionary commission arrangements. Back in January of this year, they announced that using their powers under Section 166 of the Financial Services and Markets Act, they would be reviewing historical motor finance commission arrangements. The FCA paused the 8-week deadline that normally applies for motor finance firms to respond to consumer complaints. But that pause initially was only announced in the context of discretionary commission arrangements. Following the key case that we've been discussing of Johnson, the FCA announced that the deadline of this pause was being extended to December 2025, and on the 21st of November, just now, following Johnson and First Round Bank, the FCA announced that it was also going to be investigating non-DCA motor finance cases as well. However, this is probably not the end of the story. First Round Bank has already said that it will be appealing to the Supreme Court, and the FCA has said that if permission is granted, the FCA will be applying to intervene when the case reaches the Supreme Court. So watch this space. I know that I'm thoroughly over time, so I'm going to stop talking and hand over to whoever is next. Thank you very much for listening.
Thank you very much, Ella. We are going to hand over now to David Hopkins. He acts in claims for and against financial institutions and for regulators and regulated parties in both contentious and non-contentious work. His interest in the area stems from his career in the city before coming to the bar, where he was an FX and interest rates derivatives structurer. He's going to talk to us about crypto assets, and I'm going to hand over to him now.
Thank you very much, Fenella. So I'm going to talk to you about regulation of crypto in the UK in 2025. But before we get to where we're going in crypto in 2025 in the UK, I think it's probably useful to know where we are currently and how we got here. Crypto is fundamentally a borderless and international means of exchange. And there has been historic action taken by international bodies such as the Bank for International Settlements and IOSCO, and indeed the G20 FSB. That's the Financial Stability Board rather than the other FSB. And in 2023, as you can see there, the FSB released its global regulatory framework for crypto asset activities, which included some high-level recommendations. They're very much high-level. One of the key principles underlying them is that same activity, same risk, same regulation. So there's a desire to avoid regulatory arbitrage, or indeed simply a failure to regulate an area of financial activity which has the same risks as traditional financial instruments and so on, and therefore can create the same risks. But you can expect the financial regulators within each G20 country to follow those high-level principles, and indeed that is reflected in what our regulators, the FCA, Payment Service Regulator, and so on, have been proposing. I'm just going to do a short bit of background on stablecoins, as stablecoins were initially set to come into the payments services regime next year, but I'll come on to what's happening with that in a moment. But just to give you a bit of background. So people will be familiar with crypto assets in general, I suspect, but specifically stablecoins. Unlike, for example, Bitcoin, stablecoins are intended to maintain stable level of purchasing power. That might be, for example, a stablecoin such as Tether USDT, which is fixed to always equal $1, or Circle offers its own stablecoins in dollar denominations and euro denominations. They tend to be backed by real assets. There are other stablecoins which, for example, say they're pegged to gold constantly. That might be the issuer of the stablecoin will maintain that purchasing power either by actually backing the issue of each stablecoin with a real life asset, such as a dollar held in cash reserves or an ounce of gold, for example. Or they might be algorithmically pegged. What that means, in effect, is that the issuer acts as a central bank would in maintaining a peg for a currency. To give you a quick example, Hong Kong dollar is pegged against the US dollar in a window of 7.75 to 7.85, and every time it approaches starts to approach the outside of that band, the Hong Kong central bank will sell or buy as required to ensure that it never leaves that narrow window. The algorithmic pegs are meant to do the same thing. So the issuer would buy or sell the stablecoin in necessary amounts as against the dollar to ensure it doesn't leave that peg. Doesn't always work, unfortunately. And one of the famous examples there is Terra UST, which in 2022 spectacularly crashed following some traders deliberately attacking the peg and lost about 2 billion in the space of a few minutes. Otherwise, stablecoins do have broadly the same features as other cryptocurrencies. I've listed them on the slide there, I won't go through them. The key point of difference is that unlike Bitcoin or other, as they're called, altcoins, stablecoins maintain a stable purchasing power. For that reason, they are potentially attractive to a broader range of persons, individuals, companies, etc., who may wish to use them for what looked like traditional money use purposes, such as simply purchasing consumer items, for example. Now, Bitcoin was first launched in 2009, and I sometimes fondly remember when I was on a trading floor in 2011 and everyone said, oh, Bitcoin's got all the way up to $1. Do we think it can go any higher? Perhaps we should get some. and no one did, or perhaps the people who did are now in the Bahamas or whatever. I certainly didn't, and so I'm here today. Bitcoin was launched in 2009, as I say. It took regulators some time to catch up, but by 2023, HM Treasury policy was very much embracing crypto assets, and there were detailed plans released in February 23, followed by an update in October 23, in which crypto assets were going to be brought fully within the UK regulatory perimeter, starting with the intended phase 1 of bringing stablecoins within the payment services regime. The intention being that consumers would be able to use them for making regular purchases. The intention was that the PSRs would be amended, and indeed, when this seminar was scheduled, they were being amended about right now, and I was going to tell you all about that. I'll come on to in a moment why I'm not doing that. The other factor was going to be the introduction of 2 new regulated activities related to stablecoins. The FCA also announced what it was intending to do in 2023 with a discussion paper. The FCA does have some remit already over crypto assets, but that only extends to anti-money laundering, counter-terrorist financing, and then financial promotions at present. So issuing, for example, or being a custodian of crypto assets is not currently a regulated activity. In common with the Treasury's proposals, the FCA intended to focus first on phase 1 to facilitate use of fiat-backed stablecoins, such as Tether USDT, as a means of payment, and it focused on consumers. There were to be 2 new regulated activities, issuing stablecoins in or from the UK, and then custodian activities carried out from the UK or to UK-based consumers. Interestingly, the FCA's proposals, as were in 2023, proposed that the usual DISC rules would apply, including that consumers who felt they had a complaint which hadn't been validly dealt with by the firm would have access to the financial ombudsman. But the FCA didn't propose to extend FSCS protection to consumers. So that's how, roughly speaking, we got to where we are today, because just a couple of weeks ago, Tulip Sadiq, Economic Secretary to the Treasury, announced in a speech to the Tokenisation Summit that the HM Treasury now intends to implement the phase 2 proposals in full, but what had been expected apparently in February and October 2023 was that there was going to be a big bang moment where every consumer would wish to start using fiat-backed stablecoins for their purchases, or at least a large proportion. Ms. Sadiq said that big bang moment hadn't arrived, and as a result, the proposal to amend the payment services regulations is now off the table, and we won't be seeing fiat-backed stablecoins coming within the payment services perimeter next year as had been intended. However, those phase 2 proposals will still all be implemented, and indeed the new regulated activities for stablecoins will be, but now at the same time as the rest of the regulatory regime is updated. Where we are in terms of detail is slightly less clear. What Ms. Sadiq said was that the Treasury intends to engage firms on draft legal provisions for the crypto asset regime, including stablecoins, as early as possible next year. We don't know precisely when that will be. One bit of detail for those amongst the audience who are particularly interested in this area is that the government has made one clear proposal, and this presumably is telegraphing that there'll be an amendment to the regulated activities CIS order, and the government intends to proceed with removing legal uncertainty, it said, regarding whether crypto asset staking services constitute a collective investment scheme. Crypto asset staking being, in effect, where someone who currently holds a crypto asset can lend it out, broadly speaking, to others whilst they own it to earn extra money. And currently, that may constitute a CIS, but the government intends to remove the legal uncertainty. However, in terms of other detail, I'm afraid we don't have much yet. The FCA has given a detailed roadmap setting out a timeline, and that's come in the last couple of weeks as well. But as with HM Treasury, that is very much in the stage of putting discussion papers out, which will obviously need to be updated following the recent decision not to bring stablecoins within the payment services perimeter. So, sort of similar to Ella, watch this space again.
So what is the absolute latest, particularly from the FCA on this topic?
Well, the absolute latest, so that roadmap has come out. They've also put out press release talking about people's attitudes towards crypto assets. It seems really that the FCA probably is rather annoyed, I suspect, internally with the Treasury. Having put their discussion paper out in November 23, no doubt they had a lot of responses and a lot of detail, and would have been implementing actual detailed proposals pretty much now. So really it's back to the beginning in a sense. The FCA has also put out a new web page relating to crypto asset financial promotions, and I think the FCA is particularly concerned about those people who might be already in breach of the existing financial promotions rules, possibly influencers on Instagram and so on. But yes, there's still not much detail, I'm afraid.
Thanks very much. I'm going to hand over now to Gethin Thomas. Gethin has a multidisciplinary practice with a focus on commercial, financial services and regulatory judicial review. In particular, he's acted on a number of occasions defending decisions of the FOS. In fact, he and I are working together on one of those at the moment. Probably we'll be receiving messages saying, why are we doing podcasts and not getting on with our real work? Gethin, I'm going to hand over to you to talk about our consumer duty issues. Thank you.
Great, thanks very much, Fenella. Well, as I appreciate you'll all be aware, July 22 marked a bit of a watermark in financial services regulation. The consumer duty was introduced into the FCA handbook, followed 2 rounds of consultation in 2021. Now, in my 10 minutes, I'm going to provide an overview of the consumer duty, as well as talk about some recent and ongoing FCA activity in respect of both monitoring and implementation, which I think indicates the direction of travel. So if I could please have the next slide. So as a reminding, what is the consumer duty? Well, it's one of the FCA's regulatory principles that are set out at PRIN 2.1.1 of the handbook. It's principle 12, and it's to act to deliver good outcomes for retail customers. Now, it's not just a duty of process. Putting procedures in place as a matter of compliance is obviously an important part of the duty, but it's primarily a duty to deliver outcomes. And I think in general regulatory terms, I think that's kind of unusual. And we can see, even compared to the other 11 principles on the slide, they're couched much more in terms of process-driven requirements, duty to have regard, to take reasonable care, and so on. Please go to the next slide. The FCA have explained, though, that the duty is underpinned by the concept of reasonableness, which is an objective test, and the obligations on firms will be interpreted in accordance with that standard. What could reasonably be expected of a prudent firm carrying on particular activity in relation to products and services, and that will take account of the needs and characteristics of customers in the relevant target market. So it is to a degree a duty with some elasticity to adapt to diverse circumstances, but as we'll come on to see, although it does specifically adapt to particular industries and particular target markets and customers' requirements, it is also subject to some pretty heavy specific prescription from the FCA. And the FCA identified 3 main factors which will influence how that duty applies. And they're set out on the slide there. The first, nature of the product or service. Well, is it complex product? Is it a particularly high risk product? And then with regard to the second, are we dealing with very sophisticated customers or vulnerable customers? Are there any Equality Act protected characteristics engaged? And then with regard to the third, the firm's role, are they having a direct and immediate relationship with the customers? Are they providing advice, or are they a bit further up the distribution chain? And the FCA have summarised that the duty should prompt firms to ask themselves, am I treating my customers as I would expect to be treated in their circumstances? And are my customers getting the outcomes from my products and services that they would expect? And the detail of what the duty consists of is set out in PRIN 2.A of the handbook, which was published in July 2022, as I've said. And alongside the introduction of that duty at the same time, the FCA also issued finalised non-handbook guidance, FG 22.5, on the consumer duty. And those two documents, I think, are the key documents amongst, I think, fair to say, the reams of digital paper that's been generated both by the FCA and others on the consumer duty. So who does the consumer duty apply to? Please go to the next slide. So the FCA have explained that it applies to obviously all firms within its regulatory remit, with a key role in delivering retail customer outcomes, including those with no direct customer relationship. And the FCA's guidance on the consumer duty provides that the retail customer definition aligns broadly with the scope of its handbook or other regulations in each sector. And the examples are there on the slides. We see that the key activities: consumer credit, deposit taking, insurance, investments, mortgages, payment services, and e-money providers. Interestingly, on the next slide, the FCA gives an important qualification that in relation to investments specifically, the duty doesn't apply to customers who are treated as professional clients who meet the particular rules and requirements under COBS. It does apply, though, even when you've got to a professional client, in regard to the process that the firm uses to get to the compliance with COBS stage. The consumer duty will bite. So up until that crystallization point where the customer is now being treated as a professional client. And as I've said, it applies not just to immediately, directly customer-facing firms, it applies right the way through the distribution chain. So please can I have the next slide. All firms involved in the manufacture, provision, sale, and the ongoing administration and management of a product or service to the end retail user are caught by the duty. And that includes all firms who determine or influence the design or operation of retail products or services, communications with retail customers, and customer support for retail customers. There, as I mentioned, that elasticity, it applies here as to whether or not a firm's responsibilities under the duty are directly working with customers or whether they're a bit further up the distribution chain. There is a degree to which the scope of the duty will adapt exactly to what the firm is doing and how far removed they are from the end consumer. But the FCA has made clear that wherever you lie in that distribution chain, where reasonably practical, you've got to comply with the duty within the context of your role. So it's important, I think, to bear in mind why the consumer duty exists. Why introduce it at all? Well, the FCA explained on the next slide, please, that the purpose of the consumer duty is to provide retail customers with a high level of protection, and that's required for common sense reasons set out on the slide there. Typically face a weak bargaining position, and I think interestingly, those are susceptible to cognitive behavioural biases, as aren't we all? And they may lack experience or expertise, and frequently there's information asymmetries in the retail market business. In terms of when the duty came into force, well, there was a staggered implementation. So for open products, that's products and services purchased after the 31st of July 2023, or contracts entered into after that date, it came into force on that date. Then in respect to what referred to by the FCA as closed products, so anything essentially entered into before that date, that implementation or the enforced date is a year later, which is the 31st of July this year. So now all retail financial services are covered. So the duty itself, what PRIN 2.8 covers are 3 cost-cutting rules and then 4 outcomes. I'm going to give an overview of those and then, as I said, address supervision and enforcement of the consumer duty. And I'll briefly talk through in particular some of the FCA's recent implementation sort of research and findings. So the 3 cost-cutting rules are there on the slide. Their purpose is to provide clarity on what the FCA expects from firms, and there's a significant degree of overlap, which I think is illustrated there in that example of good faith. So the first of the 3 cost-cutting rules is that firms must act in good faith towards retail customers, and that's on the next slide, please. And the FCA sets out, as we're talking about the sort of heavily prescriptive nature of the handbook on this, sets out some examples there of when a firm is not acting in good faith. And the FCA has emphasised that it's not just about the customer-facing aspects, that internally with the firms, they need to ensure that their culture supports and is conducive to their staff acting in good faith. And they note that a firm is unlikely to be able to act in good faith if there are staff incentives, performance management or remuneration structures that are likely to cause detriment to their customers. And it's noteworthy, I think, that the FCA had to spell out specifically that acting in good faith does not mean a firm is prevented from pursuing legitimate commercial interests or seeking a profit, but it has to do so in a way that's compliant with the duty. The second cross-cutting rule is avoid foreseeable harm. Now, on one view, it would be hoped that it wouldn't be necessary to have a rule requiring firms to avoid causing foreseeable harm. It's a little bit like Google's former motto, don't be evil. You'd hope it goes without saying, but here we are. So firms are required to be proactive and take reactive steps to avoid causing harm to customers through their conduct, product or services, where it is within their control to do so. And on the slide there, I won't read them out, but I've set out some of the examples that the FCA gives of avoiding causing foreseeable harm. And they've advised that the FCA have advised that firms should proactively consider how consumers' behavioural biases, such as inertia, again, which I think we're all capable of from time to time, might lead their products or services to cause foreseeable harm. And it's noteworthy that also that the FCA have again found it necessary to make clear what the limits of this obligation are. It says that the firms aren't under a duty to prevent all harm, and there are a few examples on the following slide of what that means. So the third cost-cutting rule is to enable and support retail customers to pursue their financial objectives. And the FCA have again given examples of guidance of what that requires on the slide. Where a firm declines to provide a customer with a particular product or service, the firm should still consider whether there's information or support it could provide to help the customer pursue their financial objectives. So I said at the outset that this is a duty that's not just about process, it's about outcomes. And again, those outcomes are prescribed quite carefully and thoughtfully by the FCA. Those 4 outcomes are there on the slide. So the first, the products and services outcome, and the overarching purpose of this is to make sure that products and services essentially fit for the purpose that the consumer requires them. And I've set out on the slide there what's required. And interestingly, the FCA makes clear that in complying with this particular outcome, firms may wish to consider taking an inclusive design approach to meet the needs of consumers in their target market, including those with characteristics of vulnerability. And there's a very helpful, I think, illustration of this from the FCA on the next slide. These slides, I think, will be available after talk, so you'll have a bit more opportunity to read these at your leisure. The second outcome, I'm going to gallop through these in the interest of time, the price and value outcome. The essence of this is that products and services are to provide fair value, and PRIN 2.8.4.1 on the slide there defines the concept of value for the purposes of this and prescribes a general obligation on manufacturers. So you've got to undertake an initial value assessment for the product or down the line any significant adaptation of a product before it's marketed or distributed to a retail customer. In September 2024, the FCA published a proper practice update addressing this, a good and poor practice update addressing this outcome, and that focused on cash savings, guaranteed asset protection insurance, and platform cash services. There's a useful read to see some instances of real-world examples of where this is going well and where this isn't going so well. Outcome 3, very briefly, consumer understanding, and the essence of this is that it wants consumers to be given the information they need at the right time and presented in a way that they can understand. And the handbook, again, is very prescriptive about what information needs to be provided. You've got to do it in a logical manner, use plain language, and so on. Finally, the consumer support outcome. That requires that firms should provide customers with the support they need to be able to fully utilise the products and services that they've got. And they're adequately supported throughout the life cycle of that product or service. And I'm sure we've all probably experienced some breaches of this duty, and there's some examples given there on the slide. And finally, with regard to monitoring and supervision, so firms themselves are under an obligation to monitor, and the handbook explains the purpose of that so that the firms can identify where there are risks that they're not meeting those cross-cutting obligations and the outcomes. The FCA in the guidebook, in the handbook, as I've set out there, sort of gives some specific guidance on what needs to be done. And in terms of supervision, we're seeing that the FCA is taking a very proactive role in supervising the implementation of the consumer duty. It's published a series of reviews from its monitoring and supervisory activities, which are there on the board. And I just think it's quite interesting what recently in a speech of the FCA's Director of Cross-Cutting Policy and Strategy said in November 2023, and she emphasised that the FCA was going to focus on firms' complaints data, and obviously the best source of that, identifying firms in respect of which the Financial Ombudsman Service upholds high numbers of complaints. And Abby Thomas, the Chief Executive and Chief Ombudsman of the Financial Ombudsman Service, gave a keynote speech in July titled The Consumer Duty 1 Year On. And she explained that the service were routinely receiving complaints about things that happened since the implementation of the Consumer Duty. And in particular, she noted that overall poor administration and customer service continue to be one of the biggest areas of complaints. So the Financial Ombudsman Service, they're effectively on the front line of the enforcement of the Consumer Duty in individual cases. So again, it's a bit of a watch that space, which may be a common theme. I think, Steph, you're now obliged to say that at the end of your talk. So I think that's my time up, and I'll hand back over to Fenella. Thank you.
Thanks very much, Gethin. So do you think this is going to lead to some tangible change in the way that services are being provided?
Yeah, I do. I mean, I think it's interesting in one of the most recent reviews from October on pay service firms, the FOS did a kind of audit of 23 firms and found that just over half were compliant and just under half, I think, room for improvement. But I think given that this is quite a significant change, and given that there is essentially a lot for firms to be doing, obviously I think that the FCA will want to see that proportion increase much more towards compliance. But I think overall we are going to see some significant changes, and where there are changes, I think you can expect ultimately the FCA to sort of take action.
Yeah, I think it'll be exciting to see, you know, where the fangs finally come out as well and are sunk into the sort of miscreants. Well, thanks very much. I'm going to hand over now to Steph David. Steph is ranked in the directories for public and administrative law, and she has a particular expertise in the regulation of private entities across financial services, the energy sector and health. She's recently co-authored and edited a forthcoming book entitled The Law of Net Zero and Nature Positive, and that deals with, among other things, the transition in the financial sector. Steph's going to talk to us about appointed representatives, and I'm going to hand over to her now.
Thank you, Fenella. So I'm going to focus on the decision of the Court of Appeal and KBB Consultants, which was handed down on the 9th of July this year, and it raises a number of questions in relation to appointed representatives. The case itself deals with kind of two main issues. The first was concerned with the operation and operation of collective investment schemes on the one hand, and on the other, the promotion and marketing of collective investment schemes, which is beyond the scope of this talk. What I'm going to focus on is the second issue, which is in relation to whether Kettian Capital Limited accepted responsibility for its appointed representative, Jacob Hopkins Mackenzie Limited, in relation to various regulated activities for retail clients. The judgment involves consideration of distinction from the Anderson and Sense Networks case between what activity may be carried on and how a permitted activity is carried on in the context of an authorised person's Part 4A permission from the FCA. In my view, the kind of broader question is what governs the arrangement act between the principal, so the authorised person under the Financial Services and Markets Act, and the appointed representative. Is it the terms of the appointed representative agreement? Is it the extent of the principal firm's Part 4A permission from the Financial Conduct Authority? Or is it the overall investor protection purpose behind Section 39? So my talk's divided into three parts, starting with the basics, I'm sure many of you will be familiar with, before I look at the decision of KBB in more detail, and then consider where we go from here. So in terms of the basics, the general prohibition is set out in Section 19, I should say, of the Financial Services and Markets Act. It provides that no person may carry out a regulated activity in the UK unless he or she is an authorised person or an exempt person. That provision is considered alongside Sections 20 and 23 of the Act. Section 23 makes it clear that if the provision is breached in certain circumstances, that will constitute a criminal offence. Part 4A of the Act sets out provisions in relation to the FCA granting permission to carry on regulated activities. I just draw your attention there to Section 55E, subsection 5, which stipulates that the FCA can incorporate into the description of the regulated activity such limitations as it considers appropriate, which includes limitations as to circumstances in which the activity may or may not be carried on. And then finally, that last bullet point on the slide is in relation to types of clients. And this is set out in COBS, which Gethin referred to earlier. And I draw your attention in particular to COBS 3, which sets out the different categories of client and the procedures that must be in place for distinguishing between those categories. In terms then of section 39, so a bit of background, this was established in 1986. It applied initially to investment services activity before being adapted and applied to a broader range of financial services activity through the Financial Services and Markets Act. Its initial purpose was to enable unauthorised persons, such as self-employed sales agents of life insurers, to distribute products to consumers under the responsibility of the principal, which they represented without themselves requiring authorisation. So essentially set out in that first bullet point, it was concerned with outsourcing the regulation of appointed representatives to authorised persons. And that was cited by Lord Justice Nels in the KVB judgment, referring back to what Lord Justice Richard said in the Anderson judgment. And the principal reason for that is a question of proportionality in terms of the regulatory approach that was adopted. In terms of approximate figures, so from last year, 2023, the FCA indicated there are around 35,000 active ARs, but numbers do go up to around 40,000. And the growth area is tied to consumer finance and pensions and retirement income. In terms of then that last bullet point, it's really important to flag at this stage is the investor protection purpose, which is one of the key objectives behind this regulatory provision. It was referred to by His Honour Judge Waxman in the Ovcharenko case as a particular safeguard for clients and a long-stop liability target. Essentially, it's a separate statutory route to liability and sits alongside the common law principles of, for example, agency. Essentially, what it does is renders the principal liable to third parties and accountable to the regulator in relation to the activities of the appointed representative. So here are the key provisions in section 39. You'll see that operates on the basis that an appointed representative becomes an exempt person in relation to the general prohibition, provided that certain conditions are met. The first of which is that person's entered into a contract with an authorised person, which is an important point that I will come back to. And that contract permits him or her to carry on business of a prescribed description, which is set out in the Financial Services and Markets Act, appointed representative regulations, and any requirements are prescribed in that contract. The principal must have accepted responsibility for the activities in carrying on the whole or part of that business, which again is an important part of the Court of Appeal's reasoning in this decision, and accepted that responsibility in writing. And then we look at section 39, subsection 3, that is essentially the liability provision, which sits alongside section 39(1), which is the exemption provision. Indeed, the liability provision essentially ties in the point I made earlier in respect of making the principal liable to third parties. That could be in relation to civil or criminal liability, insofar as it's provided for under the Financial Services and Markets Act. And it does enable the regulator to hold the principal responsible for all activities of the appointed representative, but only insofar as that points towards the principal's compliance with the regulatory regime. So that ties in with the subsection of the FCA handbook. In terms of then the KVB case, so essentially the facts were that the Part 4A permission for KVB was that in relation to certain regulated activities, it only applied to retail clients. The other point was that the actual appointed representative agreement prohibited the appointed representative, so JHM, from giving advice or arranging deals for retail clients. The critical question then really was whether that prohibition in the ARA was a permissible limitation on the scope of the ARA agreement as to what activity may be carried out, or an impermissible attempt to prescribe how the permitted activity is carried on, which is a distinction drawn from the Anderson case. So the majority of the Court of Appeal essentially said that excluding certain categories of client goes to how the permitted activity is carried on, rather than what the activity could be undertaken, whereas Lord Justice Lewison was in the minority. In terms of then the majority judgment, the focus of the decision of Lord Justice Mills, who gave the majority opinion, was in relation to the meaning of a business of a prescribed prescription and the whole or part of that business in the context of the statutory purpose. So in terms of business of a prescribed prescription, that is again a reference to Regulation 2 of the AR regulations. He observed that that's a generic description and it's defined in no way by reference to categorization or classification of clients. In terms of the whole or part of that business, he essentially said that it was involved in enabling a principal to grant permission and to accept responsibility. But if it was interpreted in such a way as to allow a principal to say that it was only in relation to one category of clients, that would undermine the investor protection principle and purpose behind Section 39. And that third bullet point is in relation to essentially how you undertake an assessment of suitability of an investment. It wasn't in dispute before the court that essentially is how you do business, and therefore you can't contract out of that by your ARA agreement. And essentially the majority said, well, by analogy, the same applies to client categorization. You can't contract out of a poorly made decision in respect of client categorization that would then undermine the regulatory regime. So in terms of that penultimate bullet point, what the court observed was the ARA term that JHM should only deal with professional clients operated solely as a contractual term between the principal and the appointed representative. It did not affect the scope of the permission given for Section 39 purposes. What was interesting that even in the majority opinion, Lord Justice Mills did have some reservations in respect of the fact that KCL only had permission in respect of certain categories of clients. And so how therefore was it possible for them to pass on in the maxim something it didn't itself have from the FCA in terms of authorization. And indeed that ties to the minority opinion given by Lord Justice Lewison. It's a very, very brief judgment because he acknowledged the fact that the point hadn't been fully and properly argued before the court. But essentially his point was that bearing in mind the wording of Section 55E, subsection 5, the fact the FCA can impose limitations on a permission, how is it possible that a person who isn't actually, strictly speaking, authorised in respect of, for example, retail clients to carry on a particular activity, how then can they pass that authorisation on to a appointed representative? But he then noted the need for further argument. Unsurprisingly, there was an application for permission to appeal to the Supreme Court, and that was granted in October. I just have three observations really to kind of conclude my talk. And again, I'm sorry, it is very much a theme in terms of watch this space. The first one is in relation to the importance of the Part 4A permission granted by the FCA. Going back to the explanatory notes to this particular provision, so Section 39, it really is flagged there, wording. The principal who must therefore have permission for all the regulated activities they carry on. And indeed, that point is also flagged in the commentary from Jackson and Powell on professional liability. The second is kind of tying in with what Gethin said in relation to the consumer duty. I mean, given the kind of shift in the regulatory landscape and the emphasis on protecting the consumer, how does that then play out in the context of the investor protection purpose here? The FCA did have an announcement in relation to the changes to the AR regime going hand in hand with the consumer duty, and emphasising the fact they reinforce each other in increasing protections for consumers. And the FCA went further than that and said that in terms of the obligations of principals, principals are required to oversee the actions of their appointed representatives. So, you know, in that regard, where does that leave principals? I mean, to cover themselves, there has been commentary to the effect that in the actual ARA itself, they may have to require, for example, promotional material to stipulate the limitation in respect of client category. And then finally, just in terms of that last point, I'd be interested to see if any entity applies to intervene in the Supreme Court decision, just flagging the possible contenders. The FCA would be the obvious one, given its role in respect to regulatory oversight. Perhaps also the Financial Ombudsman Service, given the point around a retail client goes to the question of eligible complainant and compulsory jurisdiction. And then finally, the Treasury could have a potential role, given it has got power to issue orders in Section 39(4) of the Financial Services and Markets Act. But thank you very much.
Thank you, Stephanie. So if you were a betting woman and you had to put some money on it, what do you think the Supremes might do?
I think it's really difficult to say. It's finely balanced. I do have a think there's a high chance the reasoning of Lord Justice Lewison, which is on the basis that if a principal hasn't got permission in respect of undertaking a regulated activity for certain client groups, how can that entity pass on that permission to an appointed representative? So I think there's a high chance it goes in that direction. That outcome would also fit with the kind of broader regulatory purpose of proportionality and encouraging innovation and competition. But it does pull against the investor protection principle. So if the Supreme Court were to go that way, it'll be interesting to see what the FCA and the Treasury do in response.
Fantastic. Thank you very much. Well, thank you to all our speakers. Thank you very much to all of you staying listening. And for those of you who are listening on another date, perhaps will be proved either right or wrong. Anyway, thank you very much.